With all the uncertainty in the world right now, having as much access to as much tax-free money is extremely important when it comes to your retirement planning. Let's face it, we have a ton of national debt. We're over 31 trillion. We've got 170 trillion of unfunded liabilities. Inflation is out of control. Just what's happening in our world and the political uncertainty and the taxation risk that goes along with it is kind of mind-numbing at this point in time. And so if I were to do a poll and poll 1,000 people, I bet you 80% of those people would bet that taxes were going to be higher than they are right now 10 years from now. And I think if you don't realize that, and you don't realize the fact that if taxes are not higher than they are today, then we're probably going to be in a crisis that is like nothing we've ever seen before. And so that is the reason that we need to have as much access to tax-free capital as possible, especially in retirement, to eliminate that taxation risk. Because if you have $1 million, and the government increases taxes and you have money in taxable accounts like 401k, they raise them by 10%, that means you lost $100,000 and there's nothing you could do about it. So make sure you subscribe and hit the bell, that way you're notified every time I launch a new video. Let's get into this. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and for this video, we're talking about the 5 different ways that you can get access to cash in retirement completely tax-free and utilize it in different ways to help you reach your goals and to protect yourself and hopefully eliminate taxation risk as much as possible with all of the craziness that's going on in the world. So without further ado, let's just go. The first way to do it is probably the most common way and the one that most people know about, so that's why I'm starting with it. It is a Roth IRA. If you put your money into a Roth IRA, then you are able to grow that money on a tax-free basis. You are able to access that money tax-free in retirement, and it is a beautiful thing. Now, some of the downsides to Roth IRAs is that there are limits to who can contribute to it. It's one of those things that the higher net worth people are not able to participate in Roth IRAs. For the past several years, even currently, as I'm filming this, you are able to do backdoor Roths where you fund an IRA and you backdoor that money into a Roth IRA, but those loopholes are closing right now. And so you're not gonna be able to do that much longer, so it's not something that you're gonna be able to depend on. And so it's important for people who are in the upper income brackets to be thinking about alternative ways. However, if you are not in the upper income brackets, I would absolutely suggest that every single person max out your Roth IRA contributions every single year and make sure that you maximize the amount of tax-free income you're able to draw from those accounts during retirement. I would even encourage, if you have an IRA, do an IRA to Roth IRA conversion if possible. Now, you're gonna wanna talk to your CPA, check out the tax implications, so on and so forth. But remember, you're never getting out of paying taxes, right? You're always gonna have to pay the taxes on that money. What you always wanna do is make sure that you're looking at the penalty and making sure you're avoiding the 10% penalty for anything before you're the age 59 and a half or older, right? And so that's something to consider. So a Roth IRA is the first way. So the second way is actually a way that is really misunderstood, and it's a missed opportunity for a lot of people. And that is an HSA account. Now, the beautiful part about an HSA account is that you can put money in tax deductible, it can grow tax-free, and then you can have tax-free access to that money if you use it for medical bills. And let's face it, when we're in retirement, we're gonna have medical bills. Now, here's one of the cool parts about this that most people don't realize, is that if you wanna put your money in and have it be a tax deduction and grow tax-free and access it for medical bills in retirement on a tax-free basis, you are able to, while you're going through your working years, or when you're actually saving and accumulating money. One of the things that people don't realize, if you keep track of it and you keep records and you pay for your medical bills out of pocket, one of the things that you can do is you can actually reimburse yourself for previous medical expenses. So it's kind of a hack in getting your money to continue to grow for you on a tax-free basis and being able to access capital in retirement tax-free, because now that can become a stream of cash flow for you, right? So if you're working your entire life and you have medical bills and let's say you're 60 and you have some medical bills and you pay those out of pocket. Well, instead of using your HSA account, let's say you have enough cash flow and you're in good shape. Well, now when you're 70 years old and in retirement, you're able to go back and you're able to reimburse yourself for previous medical expenses out of your HSA account. You're able to legally do that, and that becomes tax-free income for you in retirement. That could be a pretty powerful thing, even if you don't do that, because I realize it's gonna be a unique individual that's able to take advantage of this sort of loophole. But the bottom line is, even if you're not able to do that, having that money in an account to cover your medical expenses is gonna be vital, because let's face it, the older we get, the more likely it is that we're gonna have medical expenses, and there's gonna be out-of-pocket money. So making sure that you have a bucket of money tax-free to cover that is gonna be nothing but helpful for you. Now, the other side of it, let's say you're extremely healthy and vital and full of life, and things are going really well for you, and you're not like most people, and you have this big pile of money in your HSA, and you're like, I just want to use the money because I'm not going to need it for health issues. Well, you're able to utilize that money for retirement, and at that point in time, it's just going to function very similarly to an IRA at that point in time. So you can utilize it in different ways, and it just creates flexibility, because if you think about it, you put money into an IRA, it's tax deductible, it's gonna grow tax-free, and then it's gonna come out as regular taxable income, right? And so an HSA is going to have those same exact properties if you don't use it for medical expenses. It just has the little twist on it where you get the tax advantages if you do use it for medical expenses, which IRAs do not provide. So I would look at, if you can, max out your HSA before you start maxing out your IRA, and that is going to be an extremely beneficial way to kind of grow your money and leverage it from a tax-free basis in retirement. So the third way is actually reverse mortgages. Now, I know there's a lot of negative talk on reverse mortgages, and I'm actually going to be bringing a guy onto the channel and talking and interviewing him about reverse mortgages, because reverse mortgages, even though they've kind of had a bad rap and they're not right for everybody, at the end of the day, for people that didn't plan well enough and for people that maybe don't have enough income for retirement, utilizing your home and the way that they kind of set up the reverse mortgage as a loan to you for income, and they're utilizing your house to back everything up, can be a great way for you to have access to a pool of money, utilizing the equity in your home to make sure that you are not having to take a step backwards as far as your quality of life goes. Let's face it, if you don't have enough assets saved for retirement, I understand the nobility of wanting to have your house paid for, not wanting to have any debt associated with it, but you have to make sure that you live life first, right? Like, you have to be taken care of, and a reverse mortgage is just a great way to be able to access capital that you otherwise wouldn't be able to leverage. Unfortunately, most Americans, the overwhelming percentage of their net worth is tied up in the equity of their home. And so this is a way to tap into that. The only thing I would say to that is it's a protection to protect the mortgage companies. You can only take 50% of your home equity typically. And once again, talk to a reverse mortgage expert. I'm going to have somebody on the channel that I've done some work with and that I trust. So talk to a reverse mortgage expert, have them look at your home, have them look at your current mortgage and liability, and you can get a reverse mortgage up to 50% of the value of the equity that you have in your home, or of the net worth of your home. So it's going to depend on, do you own your house outright? Do you have a mortgage on it already? What's the equity in your home look like? And you're going to have to go from there, but it can be a great way for tax-free income or tax-free cash in retirement. All right, so the fourth way that you can get access to tax-free cash in retirement is a way that most people don't think about, but it's so common. It is your primary home. Let's face it, if you're like me and you got a family, I've got 3 kids, I've got a big house, and I'm not gonna need this house once my kids are gone, right? Like, most people, when they get to retirement, they want to travel more, they want to be around their kids and their grandkids, they just want to experience life, and they don't want the overhead and the expense of managing and maintaining a house as they get older. And so therefore you can downsize to people who are going through life the way that you were 20 years ago when you had kids in a family that were living at home and you had the need for the big house. And so you can downsize your house, and you can get a capital gains exemption on that house of up to $250,000 for an individual, or $500,000 for a married couple. So think about that. If you sell your house and you earn, let's call it, and you're married, up to $500,000 profit on your home, that is tax-free for you. That is pretty powerful stuff. So if you're looking to downsize into a new mortgage, being able to take that home, sell it, have $500,000 tax-free, and avoid capital gains altogether is a really, really powerful thing. Now, the only caveat to this is the home that you have, you have to have lived in it at least 2 out of the last 5 years. So if let's say you're renting the home right now, the good news is if you're renting the home right now, the rule is 2 out of the last 5 years. So you could have been renting the house for the last 3 years, but if you lived in it for the 2 previous years, that still is meeting the standard to be able to qualify to get the capital gains exemption on that home. And so make sure you talk to a CPA, make sure you work everything through, but avoiding the capital gains as you downsize in retirement to go into maybe a condo or relocate or anything of that nature can be a great way to have a lump sum of tax-free capital. So the 5th way that you can have access to tax-free capital in retirement is a properly designed whole life insurance contract. This is a great way to save capital while you're growing up, while you're going through the family life. You have a need for insurance, you have a need for an emergency fund, you have a need and a desire most likely for an opportunity fund. And so this is a great way to kind of help you solve different needs as you go through life. As you're starting a family, having that emergency fund is phenomenal. It protects your family. You have the life insurance. I always call it a self-completing plan. It's the only financial product in the world that's going to make sure what you want to happen will happen when you want it to happen, whether you're here to see it or not. Now, obviously we're talking about retirement, so we're saying like you're gonna get to retirement. Nothing tragic is gonna happen to you for your family. Now, when you're in retirement, one of the big challenges is everybody deals with different volatilities in the market. Like we need a volatility buffer to deal with all the market cycles and what we call sequence of return risk. One of the challenges, if you have your Roth IRA, let's say you have an IRA or a 401k, and you're looking to distribute money from those as your income, maybe have a managed money account. Well, the worst thing you can do on negatively performing years, like it has been over the last year, the worst thing you can do is liquidate a negatively performing asset. So having access to tax-free income on years when you need it, when the market is doing poorly, to be able to allow yourself to spend tax-free income that is guaranteed, that's there for you to use, to make sure that you don't have to dip into your negatively performing assets so they can then recover, that only works to your benefit, right? That's gonna help you reduce longevity risk, because the longer we live, the more risks that we experience, because longevity risk is the greatest risk factor of all, because the longer we live, right, the longer that we're on this planet, and let's say we have a 30-year retirement, that means we're gonna see more market cycles and more market volatility, the more we have to withstand. It impacts our health risks. The longer we're alive, the more chances are we're gonna have health challenges, if not multiple times, right? So that's where the HSA comes in. And so having these things in place, an HSA, a Roth IRA, your properly designed whole life insurance contract, all of these accounts are needed to make sure that you are protected and have access to tax-free income. That way you can control the tax risk, the taxation risk while you're in retirement by pretty much eliminating it if you do it the right way. So if you want to learn how to implement this in your own life, you can go down in the link in the description below, set up a clarity call with one of the coaches on my team. We'd be just honored to be able to help you with that. It is designed and called a clarity call for a reason. We're not trying to sell you anything. We're trying to help you get clarity about your goals and objectives and figure out what are the tools and products that you need from a financial perspective to meet your goals, right? That's it. So that is it for today. If you have any questions, any comments, comment in the comment section below. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.